Hey guys, it is Wednesday, December 18th. I hope you're having a very good pre-Christmas season here. I'm going to be doing some Christmas shopping today, and this episode is going to be it's going to be a long episode. It's going to be an episode about the 8 phases of corporations, and I'm calling it From Railroads to Bitcoin. Okay. Again, before I start my episode, I'm going to ask you to go to YouTube and hit the subscribe button. If you're not on YouTube, if you're watching this on X, go find me on YouTube, hit the subscribe button. And while you're at it, hit the subscribe button on X. It's $1 a month. I put some of my content for subscribers only. It's just kind of an ego thing, but I appreciate it. Anyways, so yesterday I'm watching this amazing video of Alex Thorn interviewing Michael Saylor. And the subject of this video is, what should companies do with their money? And Michael Saylor makes this point that, listen, you can accumulate the money in cash, or you can, which is sort of a melting ice cube, right? Or you can buy back your own shares with it. But if you buy back your own shares with the money, all of a sudden you've weakened the corporation. You've made the corporation more leveraged, and you're entirely dependent on the next year's earnings. So, for example, if Microsoft right now has $100 billion in cash in its treasury. If they spent that $100 billion, they had $1 billion. Well, they can't withstand much in terms of, a downturn in their tech business. Now their tech business is doing fantastic, but who knows? So they weaken themselves, all for the purpose of, buying back their shares or paying out a dividend, which is not tax efficient. So, this got me thinking. It was a great interview, and Saylor's use of Bitcoin as kind of saving Bitcoin in the treasury is completely new. So that got me thinking into really the role of Bitcoin in corporations in general. And just coincidentally, I've been obsessed with the American business history, starting from Cornelius Vanderbilt, going up to Andrew Mellon and Rockefeller, and that series, The Men Who Built America. So I put together this very long post, and I'm going to just go through this post with you guys, and just really, I think it'll be very interesting for the debate of where Bitcoin fits in to the world in a kind of 2025 plus world. Okay, so here we go. And I really like this title I picked: From Railroads to Bitcoin, a history of American corporations in 8 areas. So I've kind of gone over the how I got into this and my reading, which is very kind of, I was actually at a dinner party the other day with a direct descendant of Cornelius Vanderbilt. And he's like, "How did you ever get into this?" And it's just, I'm a very curious guy, and one thing led to another. And anyways, I just went into this detour. And let's go through this. So the first real industry in America is the railroads. And you know what? I'm going to actually just go into full view mode here. And I'll just read it from here and explain it. Okay, so the first real industry in America is the railroads. And this industry wasn't created by Cornelius Vanderbilt, but it was essentially taken over by Cornelius Vanderbilt. And, at the very beginning of the 19th century, we had the invention of the steamboat in 1805. And Cornelius Vanderbilt was one of the first steamboaters and, built this steamboat empire, starting with, the trips from New York to Boston and Long Island and, just this area, and they're very much around New York. And he started the Staten Island Ferry. That was him. And then kind of the passage from New York to San Francisco using Nicaragua as the route. And then he also was involved in the Atlantic steamboat, from New York to London and New York to Paris. But yeah, he moved away from steam. So he was involved in steamboats and railroads to some extent, starting in 1930. But then he moved really exclusively into railroads in the 1860s, and this started with his takeover. He was a small shareholder in this Harlem line, which was one of the railroads. It wasn't even the biggest railroad. The biggest railroad was the New York Central at that time, but he was involved in the Harlem as a 10% shareholder, and city government was very corrupt at the time, and the city government had denied him access to running rails on Broadway in New York, and so they denied him access, and they were shorting his stock. So this was the city official, the councilman. They were doing this, and Vanderbilt, who had made already a fortune in steamships, basically lent them the shares for them to short the stock. Then, meanwhile, bought all the way on the way down, cornered the market, and drove the stock up 2.5 times, and basically bankrupted all his shorts. By the way, he did this a second time a little later. So these people didn't learn their lesson. They shorted it again, 10 years later, and he bankrupted them again. So this era, though, was a very interesting area because there were no taxes at all. There was no corporate tax. There were no personal tax. And corporations were largely viewed initially as sort of public interest entities. Like states knew they needed railroads, but they didn't want to run railroads. They didn't, the New York State they actually tried to run railroads, and it was very ineffective. And they sort of said, well, if somebody wants to run these railroads, that'll benefit us all. We'll give them a license to run it. That was the kind of thing that was going on in the U.S. at the time. America wasn't really interested in capitalism, and there was no financial structure to this. There was the first companies in America were banks, and the first one was the Bank of New York, actually, which is ironic because now the Bank of New York Mellon is the first company to own Bitcoin. But that was the first stock in the U.S. And by 1820, there was only 20 publicly traded stocks in the entire U.S. On the curb on Wall Street. So during this era, once railroads started really building up, in the 1860s, all of a sudden we needed this massive amount of new capital so we could lay down these tracks and maintain these tracks. And you couldn't move the tracks once you laid them down. So there's enormous capital market commitments, and you needed really big fortunes for this. And Vanderbilt was kind of the first railroad capitalist. Just used this massive fortune to really consolidate the railroad industry. That industry ultimately went bust in the 1870s, and it was overbuilt. it was from boom to bust. And it's really interesting that corporations at that point really just paid everything out as dividend. And the value of par was really important. So you'd buy a share in a company, it'd be trading at 100. You'd get a good one, it would pay you a lot of dividends, but they wouldn't keep any of the profit, right? They would really just pay it out as dividends. So the next, and there's this book which I recommend. One of my favorite books I've read recently is called The First Tycoon, which really talks about the history of Cornelius Vanderbilt. I mean, most of the book is about the steamship era, but the middle of the book and the end of the book is about his takeover of the railroad business. It's a really fascinating book about this time. So, anyways, Vanderbilt, perfected the modern corporation. And he did it out of New York, which became kind of the brain of this of the United States, right, in the 1800s. And the next big phase is this oil phase, right? So after the first thing is we got railroads, and they were initially transporting grain from Chicago, and mainly they were transporting mainly goods, not humans. But by by the late 1870s, they were mainly transporting oil because oil was discovered. Rockefeller was right there at the beginning of the discovery of oil. He built one of the very early refineries, and then he consolidated out the refineries. And Rockefeller, I would say, is the architect of the real modern corporate structure, the first structure which spanned multiple states. So this concept of the corporate trust, and he had these Standard Oils all over the place. The Standard Oil of New Jersey, I think, was the biggest one, and then Standard Oil of Illinois, and Standard Oil of Ohio, where Rockefeller was from. And in this era, still there were no income tax, and corporations were still a very early phase, and a lot of people didn't trust them, so they had to pay out really high dividends. And Standard Oil was paying out 40% dividends because it was so profitable. But even with all these super high dividends, Rockefeller had a hard time using stock to buy acquisitions. He really had to go, in many cases, just buy things with cash because people just didn't trust stocks. They didn't trust control. There were a lot of games that were played. And again, there was no income tax. So we had this period where we're just passing out all this money to the shareholders. And it really was the era of monopolies. We started really having these big monopolies, with Carnegie and Steel and Frick, and Mellon owned. Alcoa was one of the biggest monopolies for aluminum out of Pittsburgh, and in the oil industry you had Rockefeller, and you also had Gulf Oil out of Texas that was owned by Mellon mainly, and all this stuff, it moved from mainly oil into the rise of modern finance in around 1913, right? And at that point, we started having taxes, right? And there was this really big, movement towards spreading the wealth, right? Pittsburgh was not for example, was not a great place to live. There was no constraints on the environment. The air was unbreathable. The working conditions were awful, and the industry was it was sort of the worst of the industry. Very much like the kind of industry at the time in Manchester in the UK. You know, it was just Charles Dickens and soot and just terrible working conditions. And so we started having the idea of an income tax, and this was also happening right around the First World War. So we had to finance the First World War, so we started having taxes. We started taxing dividends. Now it was still pretty low. Taxes were really low, but by today's standards. But and we started having dividends be taxed. Okay, this all ended in 1929. At that point, Andrew Mellon was chairman of the Treasury, and he saw no problem at all being chairman of the Treasury and pretty much the third most wealthiest person on the planet, or the second most wealthiest person on the planet. He had stakes in all these companies, he was doing great. He built the world's largest art collection, which is now in the National Gallery in Washington, D.C. Meanwhile, of course, J.P. Morgan was on the ascent, just making deals left, right, and center, buying U.S. Steel, consolidating that out of Carnegie Steel, renaming it U.S. Steel, and all this stuff. And, if you look at The Men Who Built America, that's a great it's a great sort of documentary of this era. But now, what's happening with these earnings? Well, they're going to be reinvested into massive industrial projects, right? So you have the assembly lines of Henry Ford, and Chrysler later, you have the building of the first airplanes under Boeing, modern chemicals under DuPont. So again, we're starting to build the industrial infrastructure of America, and we need capital, we need earnings to do that. Then we get this complete and utter backlash for 20 years with FDR and the New Deal, and all of a sudden now taxes go all the way up to 50%. Rockefeller and Mellon are kind of enemies number 1 and 2. Wealth is not viewed very well at all. Nobody's wealthy. There's this one really great quote in the Rockefeller book that he was saying something like, "The only guy who has any money left right now is Rockefeller." But I mean, we're doing a 180 from the Roaring '20s, and this ends with America being kind of almost a state-run enterprise to win the Second World War under FDR. And we go from this kind of anti-capitalist world to the rise of conglomerates in the 60s and 70s, right? And again, we're in this massive risk aversion phase, right? Nobody trusts rich people. Nobody trusts any individual business. And companies are just buying other companies and creating these conglomerates, right? And, that you sort of see finance companies getting involved in movies, getting involved in, oil. It's a complete mess. And this basically does not work. And by the 1980s, we go into, again, a complete reversal where all these corporations, these conglomerates are broken up, and debt is used to do these LBOs and, rationalize these corporations. So that's Kravitz, that's the, Henry Kravitz, that's the book and movie Barbarians at the Gate, which I highly recommend. At this point, earnings are mainly just used to fund debt, right? Because we've got so much debt in these companies that just leverage up to the gills in debt. There's nothing left other than just paying the debt. It's also, if you want to look at Oliver Stone's movie Wall Street, that's That's kind of Teldar paper, and being taken over by Michael Douglas, and so buybacks emerge at this point as a better way to deal with earnings, because dividends are taxed like crazy. You have this double taxation, which brings us to where we are now, which is sort of the tech era. And, it wasn't clear in the 1990s that we were going to have these absolute tech giants like Apple Computer and Microsoft. I mean, they were big, but they weren't the scale that we have now. And really the story of the last 30 years has been this growth in tech monopolies. And Microsoft is, is the oldest really of these tech monopolies. And, over the last 30 years, they've accumulated this cash hoard of $100 billion. They've also just been on this mission to buy back their own shares, right? And so this has buoyed their shares, and we have this phenomena where FANG is just such a big part of everybody's portfolio now. But we see some cracks in the model. So the cracks in the model are that, we've had this massive money printing, really as accelerated in 2008, and COVID. And, money printing is happening at a 10% rate. And, so while these companies have accumulated all this cash and they're using some of it, it's a melting ice cube. And when Saylor, had a fairly small company kind of relative to Microsoft, he had accumulated $500 million, and he realized, wait a second, what am I doing with this money? This is a melting ice cube. If I just keep it, it's going to go down in purchasing in value. Effectively, it's going to be going down 5 or 6% per year, and in a decade, I'll have less than half of it left. Well, that's not a great idea. If I buy back my own shares, well, now my company is weakened, and how do I compete with Microsoft, which is my enemy, right? My competitor. I can't compete. So he was forced into this decision where people like Microsoft or Apple, they are not forced in. They're perfectly happy just sitting on their mountains of cash. So we now see this new model, right, where, first of all, Bitcoin is emerging as kind of the future of money. It wasn't clear to me in 2017. It started becoming clear to me in 2019. Now it's completely clear to me that Bitcoin is money 2.0. I mean, it is. Now we're going through this 20-year transition phase while it's extremely volatile and poo-pooed by the Warren Buffetts and stuff. That's kind of their last act. They hate it. But it's going to take over. It's going to just take over the future. And in this new role, right, a company really is a vehicle for accumulating Bitcoin, right? And you really have this idea of how much Bitcoin are you accumulating? What's the yield on Bitcoin, the yield per share of Bitcoin? And I think this is a really, really fundamental thing that Saylor has identified. And really, I think he's really just identified it in the last year, to be honest. So I think this is fascinating. So I definitely think, over the next 10 years, the next 20 years, we're going to start seeing a lot of these companies, instead of buying back their own shares, reducing their power. They're going to be adding Bitcoin, measuring their treasuries and how many Bitcoin they have. How many Bitcoin did they manage to accumulate? And they could accumulate it by, doing what Saylor's doing now, which is arbitrage, convertible bonds, etc. Or they can accumulate it by earning, using their earnings to buy more Bitcoin. So I definitely see this as sort of a complete eighth era of corporate America. And, I'm going to be writing about this in my book, the Big Bitcoin book, which I've, written. I'm very proud of this book. It's a thick kind of coffee table book, not cheap. We still have about 600 of them, so feel free to buy it. And then, some point next year, we'll have the third version of it. And, one of the things I really want to talk about is this era of how Bitcoin fits into corporate treasuries. Because I do think this is something completely new that Saylor has identified. So this has been a long episode. I hope you enjoyed it. It's been 25 minutes. Again, if you do me a favor and hit the like button on YouTube, I would really appreciate it. And I hope I've not been too long-winded. I will catch you later. I'm not going to be on Spaces for a while because it's Christmas. I'm headed to New York to see my old man. I got some Christmas family and friends obligation, and I'm going to be a little light on Twitter. Probably still will tweet, but I'll catch you guys later. See ya.